Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is your weekend's deep dive. We, on a weekend, do a weekly review of the base case hypothesis, the ideas, and I believe it's important to have a base case hypothesis, and it doesn't really matter what it is. I think it's just important to have this framework within which you can work so that you can check in on it every single day and say to yourself, are things still going according to the expectations? So as always, at the end, we're going to be doing a deep dive on the TA, going to show you all my live positions, any new positions I'm looking to get into, anywhere I'm looking for invalidation. But in the meantime, for the bigger picture, with a little bit of macro, it's time once again to dig in and see, are things still operating within the confines of the base case expectations? For anyone that's brand new, this was the idea. The idea was at the lows, we were too bearish and that we were probably going to run off and have this blow off top to all-time highs, followed by a global recession and a deflationary bust. The yellow squiggle was never designed to predict price or time. It was simply an illustration for the sake of this tweet. When we fast forward to today, we are more or less putting in a blow off top. I often like to do this 3 lines. I'm absolutely sick of drawing these, but we got to draw them anyway. I like to have a first angle, a second angle here, and at some point in the not too distant future, if indeed we are going to put in a parabolic blow off top, then I believe we should set a near vertical advance, which of course, once it breaks down, it tends to do so in spectacular fashion. For Bitcoin, I had a similar idea in that we were going to put in a big parabolic blow off top. We were going to have a all-time high before the halving, and ultimately the top of this cycle I was speculating would probably form before November of this year, qualifying it as a left translated 4-year cycle top, meaning the remainder of the 4-year cycle would be spent in a bear market. Since we are used to seeing 12-month bear markets for Bitcoin, this would be completely abnormal relative to prior bear markets, and it would probably span somewhere in the neighborhood of twice as long. Fast forward to today, and Bitcoin is doing Bitcoin things. Now, admittedly, it could certainly be about to trade sideways or down in the short to medium term. It is yet to invalidate itself, but we certainly have to be open to that. If, however, this is the third angle, then once we have spent a little bit more time climbing it, I will have to entertain this at least as a local top sell signal and be looking to exit some of my Bitcoin position, if not all of it, on a trendline breakdown. Of course, if we do get something like this fractal play out, right, if we do grind our way up here and then we break down, I can always, again, draw a trend line and hop back in and play a breakout on the way down. There's nothing wrong with that, but I don't want to get too far ahead of myself. For now, I want to see if we actually are setting this third angle, if we can continue higher, and if indeed we can, and if indeed we do continue to climb up here, all the while the stock market is putting in its parabolic blow off top, then to me, that has all the familiar symptoms of a blow off top, and they tend, like I said, to violate spectacularly to the downside. Thus, I will want to be not only exiting my positions, but also looking for short setups as and when they present via trendline breakdowns. I made this interesting observation this week with Bitcoin in that when we overlay the Bitcoin chart against the Wall Street cheat sheet, which of course is the fractal from the .com bubble with the weekly NASDAQ chart, you can see that it's pretty clear, at least as far as I can tell, that we have made a first angle, a second angle, and are potentially looking to set that third and final blow off top angle. So again, as always, I'm open to the market proving me wrong, but all the while I am operating within that framework, within these base case expectations, and all the while we have not been invalidated via trendline breakdowns, via losing this second angle, or even just trading sideways like this. And I continue to accept these as what is currently in play. I continue to accept my base case hypothesis, and I continue to expect further upside at a more accelerated rate than we've seen prior, before ultimately putting in some kind of top and a trendline breakdown. And then, like I said, we can think about either playing a bounce out of here should it occur, or even perhaps playing a bounce and then looking to get out of the way again, waiting for that 4-year cycle low to show up. In terms of the macro, I've long been speculating that anything you do to the M2 rate of change shows up in the inflation print, albeit with an 18 to 19 month lag. We did really well at calling the top and following this thing down live in real time on the channel. We got the wobble in the middle, and that's presented of late as a quote-unquote sticky inflation narrative. I have consistently been saying, however, I believe this to be nothing more than a short-term wobble coinciding here, and that ultimately, because of this snapback in M2, we would see continuation of disinflation, meaning more and more cold inflation prints over the coming months, before ultimately slipping into deflation as a result of these blow-off tops violating to the downside, causing a flight out of risk assets and into the dollar, which of course would drive the DXY up. Of course, driving the DXY up, synonymous with deflation. I'm not suggesting we have to stay in negative CPI territory for more than a month or two, but as I said before, it's still the base case until it's completely invalidated. Admittedly, over the past couple of months, they changed the CPI calculation, and since then, the inflation had been stickier than I had been anticipating. However, I continued to point at things such as the TMC Global Credit Impulse, which typically leads CPI by around 18 months. And you can see here the Global Credit Impulse telling us to expect continuation of disinflation before ultimately slipping into deflation for a short while, thus telling me to continue to expect CPI to come off. And again, I know this wasn't a popular idea, but for the first time, as of the 15th of May, in some time, we appear to perhaps be thinking about moving lower in the CPI, about resumption of the disinflation trend. As of the data set for CPI released in May, we have finally started to see what I believe is that third and final leg down, corresponding to this snapback right here in M2, which again I have been speculating will show up down here in the CPI print. If I pull up this chart right here, you can see for the CPI, it certainly looks like we've had that move down, that sideways wobble, and at the hard right edge, it looks to me an awful lot like it is thinking about starting to drop off and resume that third and final leg down. All of that would make sense based on everything I presented today, and I believe this is the biggest thing that the market is currently getting wrong. The market is calling for repeated sticky inflation prints, even upticks in inflation, and as a result, we are seeing this whole narrative with higher for longer from the Fed pertaining to interest rates. But of course, if we do indeed get another leg down towards 2%, the Fed will have a lot more quote-unquote credibility in holding up its hands, shaking its fist in the air and saying, we did it, we finally tamed inflation, we've got inflation back down to our 2% target. And all of this happens to be occurring against a backdrop of seeing the labour market deteriorate. In yellow here, we've got the temps, which typically leads lower, the U6 unemployment in white, and as you can see at the hard right edge, this thing is curling over and turning down. Now, it does not mean that this thing couldn't curl back up and save itself, but historically speaking, these kind of rollovers in unemployment are synonymous with financially stressed conditions, with recessions, and with severe downturns in the likes of the stock market and Bitcoin. Not only that, the Kansas Fed labor market conditions in white is leading higher at the hard right edge, the US unemployment rate in pink. Again, it can change, it can roll over, it can reverse directions, but unless it does, then this speaks to a climb in unemployment which is synonymous with recessions, and if we continue to see the labour market deterioration, then there's a very good chance that out of nowhere we are going to put surprise rate cuts on the table. As it stands right now, the market, again, I suggest to you, is completely wrong-footed here. It believes the higher for longer rhetoric from the Fed. It even is entertaining a very small outside probability that we will see another rate hike before this cycle moves back towards cuts again. Clicking out to July, the CME currently has almost no probability of seeing anything other than remaining paused. September sits at around 50-50 split in favour of that pause as well. And again, we continue to see the probability of rate cuts push back further and further out into the year. But hold that thought, because the bond market seems to think otherwise. Before we get to the bond market, the small business optimism just edged higher for the first time this year with the April readout. However, the thing is still in a hard downtrend. Again, this thing can change. It could certainly start to build. But remember, the big thing about this is first, okay, they cut the staff. If they cut the staff, again, it feeds into this unemployment narrative. If the unemployment spikes continue to present, it will force the Fed to reconsider cuts. All of this, remember, is occurring against a backdrop of record high consumer credit card debt with some of the lowest personal saving rates that we've seen in many, many years. All of this tells me the consumer is not in a good shape. Okay, the consumer has hardly any savings and has higher than ever debt, all at a time when they are possibly facing losing their job, and at a time when the interest rates on that debt and on things like their mortgages continues to put further stress on the consumer. And this is where I believe that the bond market knows something that the rest of the market hasn't quite figured out yet. I've been making the case that we have one, blow off tops in risk assets. Typically, once they culminate in that third and final angle, they tend to break down in spectacular fashion. We also likely have this M2 rate of change ready to show up, putting more pressure on the Fed to cut rates and looking for that continuation of the disinflation trend. As I said, we also have unemployment rising, okay? Synonymous with recessions. If people lose their jobs and they're already financially stressed from having record high credit card debt and very, very low savings, how are they going to cope and stimulate growth in the economy without having access to any disposable income? I believe this is what we're seeing reflected in the small business optimism index. And thus, despite this higher for longer rhetoric from the Fed, despite the proliferation of the sticky inflation narrative, the bond market does not agree. In green here, we've got the US 2-year yield, and in orange, we've got the Fed funds rate, the interest rates. What I've been pointing at for potentially being the signal is that the US 2-year yield has a history of leading lower the Fed funds rate and the onset of a cutting cycle. It happened here, 2-year yield lower, onset of a cutting cycle shortly thereafter. We saw the same thing here, we saw the same thing here, and here, and here. And for those of you that know your market history, you know what happened to the stock market and risk assets in these neighborhoods. Very tough times, like I said, all against a backdrop of potentially putting in a violent blow-off top rally in the stock market, and against a backdrop of Bitcoin potentially looking to set its third and final blow-off top angle before a technical breakdown. And so I believe the biggest signal, as I was saying, is the 2-year bond yield. Here I have in the candlestick chart the 10-year yield, and in the line chart above we've got the 2-year yield. And so the biggest question for me is, do we now see the confirmation of a lower high in the 2-year yield? Does the 2-year yield roll over and start to move lower? Does this line up with a perfect rejection at resistance for the 10-year yield, which also ultimately leads lower? Because if indeed we do see that 2-year yield lower, then it tells us to keep an open mind about seeing much earlier rate cuts than the market and the Fed would have us believe. I believe we're also getting towards an inflection point for the Dixie. This is the dollar basket, which when I zoom in has a bunch of mixed messages. Okay, the first thing I want to point out is we've got a daily cycle followed by a failed daily cycle. That failed daily cycle tells us to expect a rollover into the next daily cycle low, and for that daily cycle low to form as the lowest low out of this entire section. If indeed we do see cycle theory play out as it is expected to play out, if indeed we do see an undercut of this low, by the time we find this cycle low, we will have confirmed multiple daily closes below this upward sloping blue support line, telling me that not only have we got failed daily cycles, not only have we largely topped for the weekly cycle, but we will have had a technical breakdown of support, telling me to be expecting continuation to the downside for the DXY. Of course, if this is what we see, we will be able to confirm that the 3-year cycle low is not yet in, as I have been speculating it probably was. We'll be able to scratch off this count right here, except this is the 3-year cycle low. And during this period of time, I suspect this provides fuel for the melt up. I suspect this sends everything, the stock market, Bitcoin, the precious metals, way, way, way higher in the short to medium term. And of course, all of that would fit nicely with the idea that we are indeed going to complete that third and final angle, that blow off top in the stock market. And of course, that Bitcoin would have a chance at setting its third and final blow off top angle. So for now, whilst the downside is kind of expected based on the hints that the market is giving us from the daily cycles, the market will need to prove that to us before we can go making any assumptions. If indeed we are going to break down for the dollar cycles, now would be the time to do it. Zooming in a little bit and looking a bit more short term for the S&P 500, you can see so far, okay, not only is that right in the timing window for a half cycle low, but it's also a perfect backtest of the prior all-time high level. As of this week, we closed the week above the prior all-time high, potentially telling us that we have flipped the prior all-time high level from resistance into support. And like I said, right out of the half cycle low timing window, telling me to keep an open mind about seeing something like this. I think once we've had this final leg up, assuming we get it, we find a daily cycle low wherever that forms, then at that point we will be looking to set that third and final angle if indeed the blow off top is coming. From a weekly cycle standpoint, from a weekly cycle count, we should be expecting between these two blue arrows a left translation, meaning the top comes before the halfway point. So that might be somewhere around the July and August timeframe. Not a very popular idea. I'm seeing many people online talking about liquidity cycles going up forever, and maybe that is the case. I'm seeing many people talking about a late next year top. No way they allow this thing to crash before the elections. And again, maybe that is correct. As always, I'm open to being invalidated. But so far, so long as we continue to play as expected, then I have to be continuing to accept this as the base case and what is indeed in play. As always, we know our invalidation levels. If indeed we break down from the second angle, then something else is going on. If indeed we start to print a daily cycle low, roll over and undercut that cycle low, producing a failed cycle, again, something else is going on under the hood. But until such times as we see those invalidations occur, then I continue to expect higher prices for the stock market. The exact same is true of the Nasdaq. Again, I'm not entirely committed to this third and final angle yet. We may need to see some more price structure built out. It may end up forming out of that daily cycle low, as I was suggesting for the S&P 500. Perhaps it looks something more like this. Similarly, I'll be watching the invalidation levels, such as this second angle, very closely. If we see any kind of failed daily cycles, that will also tell me something else is going on. And if indeed these cycles continue to play out as expected, then I will be getting to full exposure. I'll be adding a Nasdaq long out of the next cycle low due in around 20 days time. The Dow Jones had a much more significant sell-off. For now though, similarly with the Nasdaq and the S&P, all the while we're above support, we are long and strong and continuing to push. Also remain cautiously optimistic that we are going to set a third and final angle in the not too distant future. And the Russell 2K still struggling to emerge after breaking this range. Again, could well be a half cycle low shakeout. We are right in the window to see that. That would be normal and to be expected. And again, we have our angle for invalidation, trade below the upward sloping red support line, and something else is going on. It'll be time to take the profit on this trade and sit on the sides and wait for a clearer read. I am still looking to short oil, but I have been very gun shy about this. I've been trying to do some introspective work to figure out what exactly it is that I'm so scared of about taking a short. And I think the answer is simply that I have enough experience with trading oil. The one thing here has trained me to expect is just as you enter what should be a textbook picture perfect setup, it likes to run your stop first and then go. So my experience in knowing this, I saw one or two of you in the comments even say that you'd stopped trading oil because of this gangster-like property where it likes to take everyone out before it actually reveals its direction. So it was awesome to see that I wasn't alone in this assessment. I am still looking to get short here, but you can see if I zoom in a bit here and take this one candle at a time, right? We had the the breakdown of the upward sloping red support line. That could have been a short with a stop somewhere and wherever you wanted to put it, right? And so far, it would have kind of chopped around and done nothing. I knew not to get short here because of the daily cycles. We had a fake daily cycle, and then we got the real one in here where I've got the count labeled with the arrow. So perhaps we should have been getting short at a breakdown of that level, but you can see it keeps wicking it and then reversing. So no sign of a clear breakdown yet. Perhaps we're due any day now for a big red candle, and if that's the case, then hopefully we can catch that. But like I said, in all the years I've been trading, and I've traded oil countless times, it has this tendency to say, here's a nice setup, you get short, for example, and then it will run your stop before rolling over. So I'm just kind of seeing if I can play as patient as possible, perhaps look for some kind of fake breakout here, and then a rollover. And I think if we can get that, that would be a pretty nice setup. It's not in my nature to be gun shy when we get such clean technical breakdowns and a failed daily cycle, but something about oil, like I said, is making me a little bit gun shy. So as always, I'll keep it real with you, okay? I'm not perfect. And I suppose the absolute worst case scenario is that this gets away from me and I don't end up shorting it, which would be a bit disappointing since I was calling for this short entry setup all the way back here. And remember how bad sentiment was for shorting oil back here. Everyone back here was saying it was a terrible idea, war in the Middle East. There were Elliott wave counts that go to $400-500 a barrel. So it would be a pretty big shame for me to have spotted that sentiment extreme, taken the contrarian stance here, and then still not end up short in this thing because I got trigger shy. But like I said, my experience in the markets has told me that there is some kind of trap coming. So hopefully we get it. I guess the worst case scenario is we miss the trade. It's not the end of the world. Either way, of course, I'll update you as soon as I take this trade. And if you're a level 3 member, I'll update you in real time, as always. Gold has fired a couple of warning signs, right? We've lost the upward sloping support line in red, back tested it. So is that breakdown, retest, resumption before a further move to the downside? It's entirely possible. For now, I want to give it a little bit of space and just see how we open on Monday or Tuesday, see what happens from there. There's an outside chance that this is an early cycle low, and the reason I say that is because the prior cycle was way longer than expected, 34 days. So if we get a shorter cycle somewhere in here, that would average just right out at 50, which would be perfect. So I do wonder if perhaps we're going to force an early cycle low here to balance out the longer cycle that we had before. The other thing that I'm keeping a very close eye on is we are getting somewhat late in the weekly cycle, and I do expect a large flush into that weekly cycle low. So keeping a close eye, but for now, still long and strong. Silver managed to close the week with a back test of the 30 level, so that is wholly positive. Admittedly, not the strongest looking back test I've ever seen, but if we can get a resumption to the upside in the not too distant future, then happy days. That is simply breakout, retest, resumption. Grant, I forgot to do XRP about 5 times, so here it is, brother. Really not a great deal going on, right? Managed to grab this thing from back here, managed to grab an entry on this cascade lower. Not sure if this is the best idea ever to enter a trade on, but for now, it's kind of working, okay? So long and strong or stopped out. We're going to find out, but for now, just kind of chopping around. If indeed some hype can be built based off of the ETH ETF, and I suspect there's going to be speculation now that XRP will have an ETF and Solana will have an ETF and all these other altcoin ETFs. I mean, if we got ETH through and got a spot ETF for ETH, why not start to wrap all the other major cryptos, all the other top 10s? Even if we don't see any of that come to fruition, I'm sure the market would like to speculate that it probably is going to get an XRP ETF in the not too distant future. So I remain cautiously optimistic, right? And in the worst case scenario, we'll just pay the stop. That is why we size the trades. That's why we always have a stop loss. Bitcoin so far is still representing indecisions, a lot of mixed messages, right? Are we about to lose the prior all-time high level in green? Perhaps. Are we about to break back above the breakout level in red? Perhaps. I know a lot of Elliott wave people are still calling for this move lower. I know that we also, from a cycle perspective, have to be open to another consolidation cycle. But if indeed we can come swinging out of here, okay, we'll remain long, we'll remain strong, and we might even be entertaining that third and final angle coming in. Okay, so I was using this fractal and saying I wonder if something like this plays out. As you can see so far, not entirely following the path. It can change and it can change quickly. It hasn't changed yet. So as ever, long and strong, and we'll see what the market can give. I'm going to do all the crypto-related equities in the level 3 member section as always. And I think the last thing to point out is the VNQ, the housing market short. It's been quite boring. It's been quite choppy. It hasn't moved a great deal, but it is, wholly speaking, going in the right direction. As you can see, the stop's been choked up, so we've got very little risk now on the table. And until such time as we get technical breakouts, okay, above those downward sloping red resistance lines, then I'll remain short and strong and see if we can indeed get some kind of flush lower, like I was suggesting we might, something like this. As you can see, we've deviated away from this quite significantly, although that is not entirely surprising since this comes from the 2008 subprime mortgage crisis. So since we don't have conditions similar to 2008, at least not at the extremes for the housing market collapse into the lows like it did in 2008, not entirely surprising that we're not behaving the same. So overall, as you can see, right, the hypothesis, which has been the hypothesis, is still in play. I cannot possibly invalidate it since my invalidation levels have not been triggered. I've not seen any sign of failed daily cycles, so difficult for me to get away from that. It should be a very big week for those bond yields, okay? If they continue higher, then we're probably going to have to take emergency rate cuts off the table. But if those yields confirm my suspicion that this is just a counter trend bounce before a rollover, if indeed the yields do head lower over the coming week or two, then for me, that will be the bond market sounding the alarms and letting the Fed know that it does not believe it. It does not believe the Fed bluff. It is calling the Fed bluff, and thus it would tell me that the rate cuts are coming much sooner than most people are anticipating. It's going to be a huge week for yields. Should be a pretty big week for the dollar. Again, looking for that thing to roll over. If it was going to roll over and move lower one final time, now is the time to do it. For gold and silver, we largely expect those retests to hold. If they don't, it will be time to start taking profit on the trades. And Bitcoin is going to have to let us know what it wants to do. The more time it spends not making an impulsive breakout to the upside, the more likely it becomes that we have to waste yet another daily cycle trading around, consolidating, and potentially even entertain sweeping the lows one final time. And for the stock market, long and strong continue to push until the invalidations are hit. Still maintain that we are probably waiting to see that next cycle low, get to full exposure, and then we should be looking to see that third and final angle come in. Again, if it does not, then at least we have a framework and an expectation to check back on, to reference and ask ourselves, are we staying on the right side of the trade? In the meantime, I hope you have a wonderful weekend. If you're a level 3 member, look out for the members video that I'm about to record for you guys. And of course, do not forget to head over to CPM's channel. We are going to be doing a podcast again with the mighty Cobra Stacker. So please go over to their channel, show them some love. Like I said, I'm going to be appearing on CPM's channel and it will be out tomorrow. around 2 or 3 p.m. GMT. So look out for that. And in the meantime, have a fantastic weekend. Until next time, God bless. Cheers. Bye.